If there's one thing that's ignored all too often at retirement, it's the impact that taxes will have on your life. Your tax return can change a lot once you've gone from working mode to retirement mode, and here are a few tax issues you need to be aware of. First, some of your deductions just may go away. Since you're not working, you'll lose the tax breaks from your 401k and your IRA contributions. If your house is paid off, you may no longer have mortgage interest deduction, and starting this year, taxpayers age 65 and over can deduct only those medical expenses that exceed 10% of your adjusted gross income. By the way, it was 7.5% last year. So it might be a good idea to bunch up any elective medical expenses you have into 1 year if possible, and to maybe contribute as much as you can to your retirement plan in the last year of work. Second, you could be in a higher tax bracket at retirement. Of course, this isn't always the case, but once you hit required minimum distribution age, which is age 70 and a half, those distributions could push you into a higher tax bracket. Couples filing jointly who have just shy of $76,000 of taxable income this year are in the 15% tax bracket, but if you toss in that extra money you'll have to take from your tax deferred accounts, all that extra income will be taxed at the 25% tax rate. This is why we sometimes recommend doing Roth conversions before you reach RMD age. If you do it right, you can take the money out and stay within your current tax bracket. And, by the way, a Roth has no RMD for the owner. Something else, those RMDs I mentioned a moment ago, they could also subject your Social Security benefits to taxation. This is a surprise to a lot of people who thought their benefits were always tax-free. Not true. The IRS formula uses half of your benefit amount and adds that to other income you receive. If that amount exceeds $25,000 for singles and $32,000 for joint filers, a portion of your Social Security benefits will be taxed. And here again, if you're able to do some Roth conversions before age 70 and a half, you might be able to avoid this tax hit as well. Remember, money you take from a Roth does not count as income for Social Security tax purposes. Nobody should have to pay any more taxes than they're legally obligated to do, which is why tax planning at retirement is so important. It's all about strategy, folks. It's what we do every single day. We're here to help.